Hello, I'm Juliette Sarli. In this week's edition of IG Macro Intelligence, we take a deep dive into the ASX-listed Big Four banks. Analysts at Citi this week upgraded their call on ANZ to a neutral recommendation from a sell, citing concerns over the bank's CEO transition appear to have been priced in. The upgrade comes just a week after analysts called time on the Big Four, saying now is a time to sell due to overvaluation and deteriorating fundamentals. Nuno Mantos will replace Shane Elliott as CEO of ANZ from May 12th after the lender releases its half-yearly results. According to Citi analysts, ANZ's new leadership will closely follow its existing strategy as the bank finalises its digital transformation and integrates Suncorp. Citi analysts have lifted their price target on ANZ by almost 9% to $27.50, calling the stock their preferred pick out of the Big Four. According to Refinitiv data, the average price recommendation on the stock, according to brokers, is a hold with a current price target of $29.24, so not far from where the shares are currently trading. ASX TradeWatch technical data show there appears to be little demand, though, for stock from investors, with the 200-day moving average sloping downward and recent weak price action. Overvaluation concerns on the Big Four are also troubling Morgan Stanley analysts, who are suggesting an imminent move away from the sector. Upcoming half-yearly earnings from Westpac, ANZ and NAB may reveal downside risks, according to analysts. Westpac has an average target price of $29.10, suggesting the stock can fall a further 10%. Citi recently upgraded its price target by almost 6% to $27.75, which is below the average consensus, but it also maintains its sell call on the stock. Only UBS recommends shareholders buy Westpac shares at current levels. Well, shares in Australia's largest lender, CBA, have risen more than 40% over the past year, continually hitting records. Despite analyst suggestions, the stock is overvalued. And despite recently raising its target price by 10% to $100, Citi is among the most bearish of the analysts on CBA. They view the only reason investors would be buying CBA would be to avoid exposures like tariff risks rather than its current value. According to Refinitiv, the average price target on the stock is $115.61, suggesting CBA could fall almost 30% from current levels. But CBA continues to defy the pessimists, recently touching an all-time high, and its ROE is at 13.1%, more than the sector average of 9.3%. And technical analysis also shows CBA is in a long-term uptrend, with its 200-day moving average sloping upwards and the 5-day moving average above the 20-day. Macquarie analysts advise caution for any investor looking to the banks as a safe haven from tariff-fueled market risks. Macquarie neutral on NAB, they're down around 3.5% year to date, around double the loss on the overall market.
Looking at the banks in the run-up to the results, which I've been a bit of a fan of NABs in the last few weeks, and not such a fan of Commonwealth Bank, and I was recommending a bit of a switch out of CBA into NABs. I know a lot of people won't bother doing that because they're welded, and certainly, they're never going to sell CBA, but NABs has been doing quite well.
You see obviously a bit more valuation appeal in NAB, like the business, and would put it onto as a buy, doing so selectively, given this does have inherent sensitivity in a more volatile environment. See it growing with GDP, like the business, like the fully franked dividend, and like the execution. Just look to see that to continue and even grow in the legacy of the new CEO.
So is it your preference of the Big Four?
It is the more favoured of those banks.
Right.
Yes, for sure.
And that is your IG Macro Intelligence for this week. We'll see you next week.